Hi, good week to all. This is Kelvin here again. Welcome to this week's latest edition of our weekly technical outlook on the major four indices that I used to cover, which is the SPX 500, the Nasdaq 100, the Hong Kong 50, the Japan 225, as well as the German 40 for the week of 28th of March to 1st of April 2022. So before we jump into its latest technical configuration for this week, as well as key levels to watch, let's take a look at the disclaimer slides first. All right. So let us start off with the momentum analysis of the indices across the globe, all the way from US, then definitely followed by Europe, as well as Asia. So let's start with the four major US benchmark indices: the S&P 500, the Nasdaq 100, the Dow Jones Industrial, as well as the Russell 2000. So what we could see is that last week performance, yes, even though it kind of slightly muted or slightly reduced in terms of this upside momentum as compared to its prior week of 6% to 8% for the S&P 500 and the Nasdaq 100, and 5% was seen on the Dow Jones Industrial Average and the Russell 2000. So it's kind of a bit of profit taking last week, but still ended in the green for both the two majors, which is the SPX 500 and the Nasdaq 100, whereas almost unchanged for the Dow Jones Industrial Average, and we start to see the Russell 2000 over here underperformed with a slight loss of close to negative 0.4%. So one of the reasons that actually lead to this underperformance of this primary small caps Russell 2000 is due to the fact of this impending higher borrowing cost that's going to come into the marketplace, which is being reflected on the global sovereign bond yields, which is includes definitely the U.S. Treasuries. So both the short end and the long end of the 10-year, we talk about from the 2-year all the way up to the 10-year, as well as the or the 30-year as well. All that has been increasing significantly in the last 2 or 3 weeks or so. So in fact, I already tweeted this morning in my market commentary, which is I do a daily commentary early in the morning over. I posted in my social media. So later I'll share with you how to actually get access to my Twitter feed to keep up to date with happenings in the financial markets, which you can actually help you in your to plan ahead in your trading journey or investing journey. So I had a key level to watch on the US 10-year Treasury yield, which is 2.55%. So in fact, last week actually it hit a high of 2.5% before coming to do a bit of minor pullback from here. But definitely we are approaching a key resistance level of this US Treasury yield. So definitely a clear break above it. We'll start to see companies that are more reliant on leverage to actually help them to prop up growth will tend to see a bit of headwinds going forward, which actually explain the Russell 2000 underperformance last week. So, but then we start to see the Hang Seng Index and the Hang Seng Tech Index also came up a fair bit last week as well, almost unchanged for the Hang Seng Index after recording close to 4% gain of the previous week. And the Hang Seng Tech Index was at negative 2%, 2.35%. Uh, Definitely a reversal, we call it a reversal from last week, a performance of 4.6%. So one of the reasons which you could explain last week's underperformance of this Hang Seng Tech, especially in the Hang Seng Tech Index, which comprises of China big tech stocks, is due to the fact that actually over at US over here, it seems to me that there's still some ding donging regarding about the clarity of the Chinese companies that is listed in the US stock exchange. Like for example, we're talking about Alibaba, like the JD.com, Netis, all this. Uh, they the US authorities saying that hey, they still feel that there seems to be a bit of challenge to actually ask these Chinese companies to open up their books for auditing purposes, even though in the prior 2 weeks there's been some signs that the China side of or the China regulators seems to be in a mode of cooperation with the relevant US authorities to allow these Chinese companies, we call it the Chinese ADRs, that's listed in US to be subjected to US accounting regulators to do the proper audit on their accounting books. So there's still a bit of unclear direction at this moment in time. that actually causes this Hang Seng Tech Index to actually underperform. In fact, it was the worst performer last week at negative 2.35%. But if you compare to okay, so we got to take things into a broader perspective. So if we expand the horizon, so if we compare last week performance against its prior 4 week average, which is much more drastic, negative 3% and negative 4.7%, they the difference is still positive of 0.3% and uh, positive at 3%, pardon me, and 2.35%. So what we could see over here is that in fact, momentum has not been so bad that it will start to reverse in a way that it actually surpass the prior 4 weeks or surpass below the prior 4 week performance over here. So we could say yes, last week was actually they're being underperformed, but the degree of or the magnitude of their underperformance is not so bad compared to 4 weeks ago. So that's able to give them a positive difference of 3% and 2.35%. So that's the consolidation that we start to see over here. So that's why we got to take things into perspective. That means we look at the weekly performance versus a longer term, a longer time frame window, or else we will be subjecting ourselves to erratic noises that we couldn't do what I call a proper or a prudent or a robust momentum analysis. So the top performer last week was the Nikkei 225 at 4.93%. So one of the reason is it could be also linked to a intermarket correlation where we start to see the yen actually weaken pretty much further against the dollar, which could actually be beneficial to Japan's exports. That tends to actually have a positive feedback loop towards their local stock market. So that could actually explain the reason of its sterling performance against the rest of the global peers last week at 4.93%. So in fact, if you look at the difference as well from the weekly performance as per se versus the prior 4 week average, it also give us the highest positive difference. We talk about this is what I call a bit of a moment. We do a bit of rate of change. So it's a momentum analysis. So this gives us a positive reading, which is the highest among it appears at 5.13%. So slight we call it negative for the German DAX, a bit of profit taking as well, negative 0.74% versus prior week of 5.76% gain. So if you compare to its last week performance against prior 4 week average is almost unchanged at 0.12%. So it's kind of a bit of profit taking that is actually taking shape in the German DAX index, as we could see over here. So, but later we got to put it into context. Yeah, this is a momentum analysis. We got to put into context with the current technical trend that we're seeing for this week. That means we are taking into account of whether has short-term momentum start to stir a bit of overstretch, whether we start to see price action coming close to key medium-term levels where there could be a potential mean reversion in price action. So that we got to take into consideration as well. So before we jump into the individual technical analysis of the major stock indices that I will share with you all, let's take a quick look on the performance of the 11 S&P sectors for last week. So what we could see over here is that definitely energy, materials, these are actually sectors that will tend to perform well in a rising inflationary environment coupled with rising US Treasury yield. So just to have a very quickly, let me explain to you all. Right now, this rising US Treasury yield environment is different from 2021. That means we're talking about a year ago today. So a year ago today, we also start to see this rising US Treasury yield environment, but that actually coincided with reopening team play. What I mean by reopening team play, so at that point in time, there was actually vaccine just started to roll out. So there's a lot of fanfare or optimism that this vaccine is once the population get vaccinated more, uh, the economy could actually open up. You could actually start to boost pent-up demand growth. So we start to see stocks like financial stocks starts to go up, industrial stocks to go up, consumer discretionary stocks starts to go up over here. But however, this time around, the rising yield curve is more related to actually higher inflationary pressure from global commodity prices, as you all could see in the last 2 or 3 weeks, being reinforced by the current Ukraine-Russia crisis or conflict that will potentially lead to a persistent global supply chain disruption in in what you call it, in the way of doing business, especially from commodity supplies as well, which with all these sanctions going on. So that this rising yield curve is actually caused by central bank policies, especially from the Fed, saying that, hey, our concern right now is more related to curbing rampant inflationary growth rather than putting a what you call it, a Fed put to allow the stock market to actually go up higher. That means a lot of people say that, hey, there'll be a potential Fed put coming to place because if higher volatility starts to stock the market against, the market will start to actually do a significant correction going forward. Then the Fed will start to, hey, put a pause to this tightening, we call it impending tightening Fed hike cycle, and start to do QE again. That probably is very slim right now because the Fed already made its attention that firstly they're going to be embarking on a series of rate hike, and now it's only that whether this rate hike will start to be in tune with market expectation or will they be start to get more aggressive if inflationary pressures don't come down. And the biggest problem over here is that what if the current inflationary situation is not within the Fed control? That means the Fed can't control this inflationary pressure, which I already highlighted sometimes in my in my daily market commentary notes in the last couple of days in my Twitter feed. There's a big risk. Why? Because the current situation right now is not demand pull; it's more cost push driven, which eventually the Fed may not have sufficient tools at its disposal to actually control this inflationary risk, which may cause a bigger problem down the road. All right, but nevertheless, in the shorter term to medium term, it tends to actually benefit inflationary play stocks like energy and materials that we start to see they have been performing pretty well in the last 2 to 3 weeks. So last week it was a top performer again. Pardon me, it was top performer again. Energy gaining 7.42%, materials 4.1%. Uh, information technology it dipped down slightly because last week was a top performer due to its huge gain last week because it was actually falling quite significantly in the last 4 to 6 weeks or so prior to that. So last week was a top performer. So right now it actually it still outperformed the S&P 500, but it's no longer at the top three. It down slightly to 2.3%. Why? One of the reasons is due to higher yield, higher US Treasury yield implies higher borrowing costs, which it could have impact a negative feedback loop into information technology stocks as a whole indirectly. Why? Because people still perceive the information technology sector itself is actually reliant on borrowings to actually drive up growth. Even though some of the component stock inside the information technology are cash rich in nature, like Apple, but they tend to actually oh, sometimes sentiment, this is how sentiment behaves. So once you have a negative feedback loop that's being fit into this sector as per se, information technology sector, it may actually surpass or actually override the individual fundamentals of the company and overshoot to the downside or overshoot to the downside or to the upside, depending on which way the markets moves from here. So the one that is coming towards the bottom of the table, real estate, as well as healthcare. So real estate primarily we all know that higher uh, borrowing costs, higher treasury yield. Uh, it's actually have an opportunity cost in holding real estate related stocks like REITs. Why? Because they are actually they reduce the profit potential of the dividend yield from this REITs itself. All right, so that could actually explain its underperformance last week. So now let's quickly now jump into the main focus, which is the technical trend bias and the levels that I have to share for this week on the various indices. Okay, so let's quickly go to the slides or the charts of the SPX 500. Okay, pardon me, just lock out by itself. Okay, let me log in again. My apologies. This is due to sometimes the internet connection just got cut off suddenly. Okay, so while it's running, okay, so let us start with the SPX 500 first, all right? So as you all know that the 4240 is the key support level that the market managed to actually did a bit of whipsaw previously and managed to stage a rebound. So if you go to the weekly chart, which I share with you all is our quarterly outlook. So I'll do a new Q2 outlook soon. So in the Q1 outlook, we're actually looking at 4240, which is it did a bit of whipsaw over here you see a bit of long shadows, but eventually it managed to actually weekly close in the prior 2 weeks at 4240 and stage a pretty strong reversal. So we are actually en route towards this 4990 maximum 5170 slash 5,400 risk zone over here. So to complete that this long term wave five, the elite wave five, to actually complete this 13 year of circular bull market before a potential 30 to 40% corrective decline takes hold. All right. So we're still looking at this rally. It could be a pretty volatile rally in terms of the rally, the or the residual potential residual rally of denial of hope and irrationality that i.e. even though we are in a higher interest rate environment going forward with liquidity tightening, but the market still believe or perceive that the Fed will able lead it to a soft landing. So that's why I call it a rally of hope and irrationality without taking into consideration that there's a risk to actually have lowered earnings growth going forward in terms of tighter liquidity, and also given that the current situation in Ukraine and Russia, as both countries, and in fact not two countries, there are various countries that are being involved, playing a game of brinkmanship, which eventually we will start to see a not so nice, unfortunately, not so clear or fast conclusion of this conflict. And it may start to have further ramification if other countries like China or India is being brought into the picture going forward. All right. So now, with that in mind, bear in mind, so we're not still looking for a last wave of hope and rally. So now we got to concern ourselves that last 2 weeks it already did a significant push up. So for this week, right, would there be a risk of a pullback first before the rally continues? Because market don't move in up in one straight line, especially if you are trading in short term, you got to understand these dynamics. All right. So now, on the daily chart over here, so what we could see now is coming very close to a key intermediate resistance at 45.90. So why 45.90 is key? Why, as you could see that it actually tested twice, refused to break on the 2nd of February and the 9th of February before it start to shape that last steep decline. All right, to hit a low of 4106 on 24th of February. And if I were to draw the Fibo retracement, taking from the current all-time high on 5th of Jan all the way down to the low of 24th of Jan, you see it's coming pretty confluence close to the 61.8% retracement as well, which is the golden ratio. So all in all, right, we start to see a confluence of a significant graphical resistance and Fibo retracement level at 61.8%. So now heading on to the 4-hour chart. So I want to see the 4-hour chart, how's the momentum like, the short-term momentum like, the 4-hour chart. So going to the 4-hour chart, what we could see is that prices has a series of higher high and it's approaching pretty soon to our target that we mentioned last week, which is definitely 45.90. So it actually printed a high of 45.46. And what we could see over here is that the RSI has already hit the overbought region, and instead of printing similar highs like the price action, it starts to shape a lower high. So you see this high is lower than this high, and it's spotted at the overbought region. So this is actually RSI. So this is a 4-hour RSI. So it's measured short-term momentum, at overbought, and it start to flash a bearish divergence. So it goes against the direction of the price action. So it's like a car, the speed of a car. So this speed of a car is traveling upwards. The car is traveling upwards, but its speed it starts to decline. So indicating to us there's a leading element, potential leading element saying that hey, the bulls right now are losing strength at least in the shorter term. So what we could see over here is that potentially there's a risk of a retracement this week after we start to see a strong rally from 15th of March low. So we took the low of 15th of March all the way up to last week's high is 10%. So the market has rallied by 10%. And given that what we see now in the observation in the RSI is negative, from this bearish divergence. So eventually we will start to see potential a pullback in place. So based on the longer term chart, the daily and weekly chart, we definitely the odds of it to actually come down much lower than this low is pretty low at this point in time. But right now what we could see for this week, that means in the shorter term, is that as long as 45.90 holds, that means it didn't surpass to the upside, we could see it potentially decline to 44.70, followed by 44.100 level, maximum 43.30, which is at the former swing high area, previously that prevent it from going much higher, and it starts to form this recent significant low before it start to shape this steep rally. So this is a key level at 43.30 psychologically, and also if you do the Fibo retracement, taking from the high, the low to the 15th of March low to last week high, is at 61.8%. All right. So all in all, right, what we could see right now is it could start to shape a potential mean reversion decline after the 10% rally that was seen for 50 March low towards 44.70, followed by 44 figure level, 4400 level, which is we call it that medium term wave two before shaping another push up. Okay. So, but however, if we start to see a kind of a fall, a daily close above 45.90, it will start to see the resumption of this very steep rally again to actually open up scope towards the next resistance level at 47.40, which is this okay 0.764 0.764 expansion level, Fibo expansion from the low of 15th of March, taken from the high of 23rd of March and project it to the recent low of 24th of March. And also the graphical swing high area of 12th of Jan and 13th of Jan this year. So all in all, right, we are still looking for a potential mean reversion decline to actually take shape below 45.90 on the SPX 500. And given that the SPX 500 moves in correlation with the Nasdaq 100, given that the top five component stocks is also almost similar in the top five component stock in the S&P X 500, which includes of Apple, definitely. And the only difference over here is that the top five in Nasdaq 100 consists of Tesla, whereas Tesla is not in the top five of SPX 500. So now for Nasdaq 100, what we could see over here is it also shaped a strong push up from the low of 15th of March. So what we could see now is coming very close to the key resistance level at 15,160, which is the 200-day moving average, and as well as this former swing low turns into a resistance level that fails to surpass it, and it starts to shape that last significant decline push down to print a low of 24th of March, then thereafter retested again on the 15th of March. All right. So all in all, right, what we could see right now over here is potentially we could start to see we call it a pullback as well on the Nasdaq 100, given that it's coming very close to this key intermediate resistance at 15,160. So all in all, let's take a look at the 4-hour chart of the Nasdaq 100, which would to actually decipher its short-term momentum. So we could see that the short-term momentum is displaying the same configuration as the one that I highlighted earlier on the SPX. Price action showing higher high, but however, the RS 4-hour RSI, instead of showing similar highs or higher highs in the overbought region, it start to flash a bearish divergence, which is a lower high, as this high is below that is low. So indicating to us that the short-term upside momentum is actually losing strength, which actually increases the odds of a mean reversion decline as well. So now we are looking here is that as long as 15,160 holds, it means not surpass the upside for this week, there's a risk that the Nasdaq 100 may shape a mean reversion decline towards the first support at 14,390, then thereafter at 13,910 before another leg of potential upside resumes again to surpass the last week high to shape that medium term impulsive wave three, right? Of this entire residual up move of hope and irrationality. So, however, we start to see a daily close above 15,160, then we could say that this steep rally will actually resume to actually test the next resistance at 15,540. Then thereafter followed by this swing high area of 12 and 13 of Jan, which is so the 0.764 Fibo expansion level taken from the low of 15th of March, projected to 22nd of March, and projected projected from the low. So it's taking from the low of 15th of March to the high of 23rd of March, projected from the low of 24th of March, give us this close to this 76.4 Fibo expansion level, which is a co-influence with this 15,780, 15,900 swing high area that was actually formed in 7th of Jan, 12th of Jan, and 13th of Jan this year. All right. So all in all, we still potentially see the risk of a mean reversion decline in the Nasdaq 100 as well. So now moving next will be the Hong Kong 50 index. So over the Hong Kong 50 index, if you could go back quickly to the longer term chart. So over the longer term chart, it has really broken below the long term circular ascending trend line that we saw previously was in place since the great financial crisis low, which is 2008 level. So it actually surpassed below it last week. So what we could see right now is after the decline of the pretty steep decline of 30 to 40% to actually close. Because if you look at this decline over here, breaking from the low, okay, close to 20% now, which is 19%. Okay, so after this steep decline over here, what we could see over here is that potentially, right, we could now come to a scenario that it may start to do this kind of mean reversion corrective rebound to retest 23,100 maximum the swing high area of 16th of Jan 2020, which is 24,700, and which is also close to this pullback former support level, major ascending support now turns to a pullback resistant level as well. So this zone over here actually offers the end game or the end potential end target of this ongoing corrective rebound level. So, but all in all, right, expecting it to actually see uh, the start of another significant recovery. It seems to be pretty much minute right now because there's not enough technical elements on the longer term chart to actually justify it at this moment in time. So in fact, if you look at the RSI over here, the RSI just dipped into the oversold level, but it didn't show previously like it started to shape this bearish reversal, a bullish divergence in the past that start to see this sharp upside reversal in price. So they do not have any similar observation over here as well. That means there's no bullish divergence, just only a dip towards the oversold level, then thereafter it reverses up from it. So all in all, right, the odds seems to be more of a corrective rebound towards this region itself, before there's another risk of another leg down to potentially could take it down to retest 18,050, which was actually the low of 15th of March last week that managed to find support level at the former swing low of 31st of Jan 2016 and as well as 3rd of June 2012. All right. So now going to the 4 hour chart. So last week, right, we say that you using 20,100 as the key pivotal support level. So what's 20,100 again? So let's have a quick recap. It's actually taken from the 15th of March low all the way up to the high of 23rd of March. It's close to the 50% retracement level. All right. Okay, so what we could see over here is and also this level that formerly was actually this low, the lower boundary of this expanding wedge configuration that is in place since 18th of Feb 2021. And previously it managed to break and start to see that steep decline and the price actually reintegrate back above it. Okay, so offering a bit of graphical support there as well as 20,100, which is coincide with the 50% FIBO retracement level that I draw earlier on for 50th of March low all the way up to the 23rd of March high. So definitely this is a key support level to watch actually to actually maintain this ongoing potential corrective rebound to actually shape the first sign or the first leg towards 23,000 slash 23,380. Okay, so which is also this graphical support resistance, graphical support turns pullback resistance, as well as the former swing high area 25 to 25th of 25 to 26th of February before the markets shape that steep decline. All right. And also from a FIBO retracement perspective, if you take it down from here, the high is also close to 76.4% retracement. All right, at the top. Okay, so all in all, we're still maintaining that corrective rebound as long as 20,100 medium term pivotal support holds to actually go back up towards the 23,000 slash 23,380 resistance level. So now, what's next for the Nikkei 225? So over at Nikkei 225, last week we are actually looking for a potential up move towards the resistance of 27,900, which has already been met last week. So for sure, if you look at the last week momentum analysis, at the start of this recording, we mentioned that Nikkei 225 was the top performer last week in terms of the rate of change. Okay, and as well as taking into the differential between the current performance and the 4-week performance. But we got to look at in perspective of what is the technical configuration that is actually shaping right now. So if you look at the technical configuration, right, it actually 26,900 was the key, was the support level, was the resistance level. It was just surpassed last week, and right now it actually hit exactly at the this top of this descending resistance that kept previous rally since 14th of September. 12 November it can't break above 12 November, November 17 November 2021, again on 5th of Jan 2022 this year. Okay, so this is a pretty clear graphical support resistance level that we got to actually respect. Okay, because one time, two time, it fails to break above. And right now, the third time as well. So right now, it's actually intend to do a turn again at this key graphical resistance level. So if you look at the from a Fibo perspective, if you draw the retracement from the last swing high all the way down to the low, last swing low is at 76.4%. All right, giving a bit of a significance to this level as well for Fibo retracement analysis. So what we could see over here is that we have actually a graphical resistance here, okay, slightly above it as well. Okay, so what we could see right now is that we reached the target or resistance at 27,900 that we highlighted last week, and price action now is actually hitting a graphical resistance level as well. All right, that is in place, a descending resistance that is in place since the high of 14th of September 2021. Okay, which is last week high. So last week high was 28,373. Okay, there about. Okay, so if you go to the 4-hour chart, what we could see over here is, hey, the price action starts to shape higher high, bank reacted off the key graphical descending resistance level. But while it's reacted off of it, you start to see a bearish divergence. All right. So this bearish divergence, right, give kind of reinforce saying that this up move from 8th of March all the way up to 25th of March, the momentum is now losing strength. I would say the upside momentum is losing strength, and there's a risk of this Nikkei 225 or the Japan 225 may start to see a pullback or a mean reversion decline this week below the key resistance level of 28,500. All right. So as long as 28,500 holds, which is actually close to last week high, uh, so I just use the graphical this graphical slide of a graphical resistance, which is the swing high of 18th of Jan, as my benchmark for this week medium-term pivotal resistance. So as long as this level holds, we may start to see a pullback towards 27,570, then thereafter by 27,100 level. Okay, 27,000 level. Okay, so 27,000 level is a graphical support or a formal resistance, all right, from this swing high of 22nd of February, 28th of February, and 1st of March. And if we take into consideration of the Fibo retracement from the low all the way up to the high, it will come close to the 8.2% retracement as well. All right, so this will be my potential mean reversion support and target that we set for this week, as long as to 8,500 holds. That means there's the price action is surpassable. If so, but however, if the price action starts to break above the 8,500, that means if there's a 4-hour close above, that means we're talking about the mean reversion decline scenario will be invalidated. So how high will it go? So will be the price action can actually continue its steep rally from or it is rally from or a persistent rally from the 8th of March 2020, 2022 low towards this level here. Let me highlight to you. Okay, at 29,390. Okay, which is the swing high level of 5th of Jan 2022. Okay, if there's a 4-hour close above 28,500. Now, next will be the German 40 index. So going for the 4-hour chart, right, the German 40 index, we're also looking for a kind of a mean reversion, a bounce back up to retest that previous significant range support. Now turns into a pullback resistance at 14,800 slash 15,000 30 level, which is this zone over here. So as you could see that previously it was a significant range support level, broken down, now turns into a uh, pullback resistance zone to actually watch from here. So now going for the 4-hour chart, if you look at the 4-hour chart over here, is that the RSI is pretty much neutral over here. So yeah, it did kind of hit the overbought zone on the 17th of or 15th of March, and thereafter the price action just goes sideways, and the RSI managed to actually hover sideways as well, holding above this corresponding key support level, which is close to at the 44% level. Okay, so it's still above this key corresponding support level at the 44% level. All right. So what we could see over here is that last week we have a medium-term pivotal support at 13,700. So what we could do is that we will actually tighten the medium-term pivotal support to this graphical support over here, which is the former swing high area of 11th of March and 15th of March. Okay, so since price managed to hover above this, so we actually tightened it to 13,900. And also if you would do the Fibo retracement from the low of 7 March to the high, okay, it came slightly above at 23.6% as well. Okay, slightly above, slightly below 23.6%. So all in all, right, what we could see over here is as long as this level holds, price action may start to do another residual push up or a push up to actually conclude this current corrective bounce in the first place towards that former major range support now turns into a pullback resistance at 14,800 slash 15,030 level. But however, if we start to see a 4-hour close below 13,900, then we may start to see the start of a or the risk of a resumption of this impulsive down move. Firstly, in first step towards the next support level, which is the swing low area of 10th of March, 11th of March at 13,600 slash 13,340 level. All right. So all in all, right, to sum up everything, this week will be a bit of mixed bag. Why? Because there's some indices, the recent rally is coming very close to key intermediate resistance like the S&P X 500 and the Nasdaq 100, where this week we could potentially see a mean reversion decline to take shape. Whereas similar for the Nikkei 225 as well, which is the Japan 225, a mean reversion decline. There, on the other hand, two indices, which is the Hong Kong 50 and the German 40 indices, there's still a bit of room for further potential upside movement for towards their intermediate resistance level before the risk of a mean reversion decline take shape on these indices. So with that, before we go, let's take a I will share with you how to actually get access to my daily morning commentary. So first of all, right, you guys need to actually open a Twitter account. It's free. So once you open a Twitter account, right, register your name. Then actually follow me. You can follow me at my Twitter handle at Kelvin SC Wong. So just find at Kelvin SC Wong. So this is me. So just click a follow and on my notification. So once the notification is on, you're able to actually receive my tweet in once I tweeted out a new tweet about the market. So this is what you see. Okay, this is my chart of the week, and this is the kind of daily commentary tweet that I tweet every morning. Okay, taking a look at what's the key news flow, what are the events that are taking shape in the market, as well as interesting charts as well that are actually posted, especially this one on the US Treasury yield. So why 2.55% is important, all right, as been depicted by this technical chart over here. So with that, do give me a follow so that I hope that with my tweets, I'm able for you to get a better understanding of what's the mechanics or the workings or the inner workings between the broad-based financial asset classes. So with that, have a great trading week ahead, and I see you again in my next video.